Hello and welcome to my video slash presentation on Newfi Non QM. This will be a hopefully quick, less than 10-minute high level overview of Newfi and our non QM products. Um, so, non QM is a big universe. Pretty much anything outside of agency and conventional loans is non QM. So, anything that's not a qualified mortgage. Um, which is a huge space, subprime, multi-unit apartment buildings, mixed use, all sorts of stuff. So Newfi is non-QM, but not all non-QM is eligible for Newfi. We like to work in a very selective space. Like to think of it as um, loans that you would send to Fannie Mae, but for you know income documentation requirements or loan terms or maybe non-warrantable condos, things like that. But as far as that goes, if your loan wouldn't work on Fannie Mae for some things, like we only do 1 to 4 units. We're not doing 5 or more units for apartment buildings. Um, we're not doing subprime loans. So just like Fannie Mae, 620 or higher, and ideally you want to be over 660. Um, Standard, I know I put SFRs here, but um, condos, townhouses, SFRs, but mainly the point is we're not able to do like your agricultural residence where you've got a house and 5 other houses, or a barn with tractor and agricultural equipment for your working farm, or your winery, or your automotive repair business. It's got to be just a residential use. Um, I do have an outlet for like those agricultural things. If that's what your scenario is, let me know. I have somewhere where I can send you to. But we're just doing residential properties. Sort of like Fannie Mae, you can have like some hobby stuff going on there. But if you have commercial stuff, we see a lot of stuff that's like a house that's been converted into a restaurant, and now they want to buy it as a house again, but it's still got a commercial kitchen in there. We're not able to do stuff like that. We also have second mortgages. That's not really non QM, but they really are big on the second mortgages. The Olympic is our full doc Fannie Mae guidelines with some overlays. The Glacial is our self employed 12 to 24 month bank statements. This is for primary residences only. We're not doing these on investment properties. So non QM, we've been doing this for 10 years. Um, with COVID, a lot of self employed borrowers have had a lot of challenges. Even though they may have great cash flow and great assets, the tax returns for the past couple of years may not show it, as well as the investment properties, DSCR loans. Um, of course, you can't do them on FHA. Fannie and Freddie have been adding like almost 2% in LLPAs for those. Um, as well as having a lot of restrictions on how you qualify. You still have to qualify with your own income. DSCR loans don't have those restrictions. I know there's a lot of big lenders, UWM especially, that's trying to move into the non-QM space, but they're conventional conforming lenders who are trying to do non-QM. That's the only thing we do is non-QM. We don't do conventional. So we like to think that we are more experienced and better at doing non-QM. We only do manual underwriting. We don't rely on AUS like some of the conventional lenders that are trying to do both. So that's what makes us stand out. So for non-QM, our main product is Sequoia. We have Sequoia Expanded, which includes our most common exceptions, and then we have Sequoia DSCR. Um, so we maintain, like I said a moment ago, it's Fannie Mae base with overlays, manual underwrites. So we get to decide whether we want to approve the loan or not approve the loan. We like to say we have 8 different ways to qualify without using tax returns. We also have Rainier, which is sort of Sequoia for ultra prime. So if you've got over a 700 FICO and under, 80%, maybe under 75% LTV, you do get better pricing, but there's no exceptions on Rainier. We also do have Jumbo AUS. So if you have a Fannie sort of loan that maybe is a non-conforming loan size, we can do those with the AUS. But again, that's very aggressive pricing, so there's no exceptions on those. Those are going to be on our jumbo program. If you have questions about that, let me know. Happy to share that with you. But so our two main pieces for Sequoia, non-QM, we do full doc, but mainly bank statement loans and DSCR. Bank statements is 40% of our business. DSCRs are the other 40%, and the rest make up the other 20%. So bank statements, 12 or 24 months. We do have the ability to have you submit the bank statements, have them reviewed, tell you what the income is before you even bring the loan in the door. Um, and we have started a pilot where you can upload them directly through our portal. So you'll be able to upload them, and within 24, maybe a little bit more than 24 hours, have the response for how much qualified income your borrower has, with a full spreadsheet on how we calculated it, so you know exactly how much we're getting. We use a base 50% expense ratio. So just so you know that up front. We do also have, like I said, we have 8 different ways. So 1099s, some people are sort of basically employees, but they get paid 1099 to save some money. We have a program for that, as well as a program for people who are truly self-employed but get a 1099. For those employees, for those self-employed borrowers with a 1099, it's a 10% expense factor. Or we can do CPA letters. Those have nuances. So let me know if you have questions or if you have a scenario like that, so I can go over those. But those are available. These are some of our niches. Um, Big ones are asset depletion, asset utilization, IRA distributions. Um, those are things that I think are highly useful, especially compared to the very restrictive Fannie and Freddie guidelines. Uh, as you can see right here, it's asset depletion is 60 months, whereas Fannie Mae, if you want to use employment related assets, those required to use the loan term in months. So Fannie Mae, a 30-year mortgage, would require you to use the assets over 360 months. So $1 million would only get you $2,000 a month, whereas on our programs, it gets you a lot more income monthly. The other big piece is the other 40% of our business is debt service coverage ratio. These are super simple loans. You're only using the anticipated rents to cover the anticipated PITI. As long as the rent is higher than the PITI, you're good to go. Doesn't matter if you're employed, self-employed, not employed, doesn't even go on the IRLA. Don't care. Um, your primary residence, we do have to have a mortgage payment history, but we don't even include that in the PITI. So very limited documentation required on these, and these can close very quickly. But another added bonus to the DSCR is that you don't have to be licensed in every state. As long as you have an NMLS license, um, you can originate a DSCR loan in 35 different states without having to have an additional license in each of those states. So you get the benefits of a super simple loan with very basic income requirements, almost no income documentation other than a rentometer, 1007, or actual market rents. And if you have a lease already, Those are your income docs. Don't need tax returns. Don't need to worry about anything in the credit report as far as expenses. Don't care. Um, Super simple loans, very quick closings, non-trid. There are some rules. Again, that would need to be a whole nother video on DSCR loans, but that's the very simple, quick and dirty 10-minute intro, high level to Newfi's non-QM. Love to be able to have conversations with you, see what we can do to get you signed up, help you get some more loans in the door and across the finish line. There's my contact information as well as our website. You can actually go there, see all of our products and matrices, as well as even use our quick pricer without even having to be signed up with us, which is very helpful. If you do have any questions, again, give me a call. Don't hesitate. I'm here to help. Thank you. Have a great day.